My name's Tim from Independent Reserve. I work in sales and business development here, and if I assume many of you know who Independent Reserve is, given you would have come in through our mailing list. But if you don't, we've been around 12 years now, kind of a staple of the Australian crypto scene. We've got a team here in Sydney, a team in Singapore, the first license exchange out of Singapore. And I got that around 3 years ago, and busy expanding into the Middle East and other parts of Asia as well. So I wanted to organize this webinar because we get a lot of questions from customers about tax structuring, how to set it up to give the right flexibility or protection or tax benefits. So I reached out to David Fam at Consensus Layer. I'll allow him to introduce himself in a minute. But just as a rough overview, David's going to go through the 4 million account structures. That'll take about half an hour, and then we'll open it up to Q&A for another 15 if people have questions. So there's just one more thing. In GoToWebinar, there's a section for document uploads. If you go in there, there'll be a handout which will basically show the slides that you see today, but with a bit more written detail that you can refer back to. This session is also being recorded, so we'll distribute this after if you missed anything or there's points that you'd like to refer back to after. So without further ado, I'll hand over to David to introduce himself and get started.
Cool. All right, let's get into it. Thanks, Tim, for that. Right. So yeah, today, as Tim's already mentioned, we're going to go through crypto tax structures, essentially optimizing for your crypto wealth. So just a general disclaimer, this is general information purposes only, shouldn't be considered as financial advice. It's important to note that every person's situation is unique. One person's situation doesn't mean it's the same as another one. It doesn't mean it's suitable for another person. Every effort's been made to ensure accuracy, but I can't guarantee that information is complete. So just disclaiming any responsibility for that. Please seek professional advice, whether that's tax or financial advice, before making any decisions. So yeah, as Tim mentioned, I'm David Fam. I'm also known as the Crypto Ninja. I'm the co-founder of Consensus Layer, a crypto tax accounting firm. I'm a qualified chartered accountant and a qualified SMSF specialist advisor. I've been in the space for tax and accounting for more than 12 years. And yeah, I love the crypto space. That's why I made this my full-time gig. So Tim's already mentioned roughly go through half an hour of structures. So individuals, trusts, companies, self-managed super funds, and a common case scenario that we get. And then about 15 minutes we'll spend on Q&A. There is a question box. If you see it on the top right-hand side of your webinar, please enter your questions and we'll answer them at the end of the session in the 15 minutes Q&A. Right, so let's get into it. Structures, we'll go through pros, cons, and a scenario for each structure. All right, so first one is the simplest one, individuals. A lot of people will start off in the individual, you start buying crypto in your individual name. The pros of that is that it's simple, right? Not much compliance to it. There's a single tax return that you'll have to do. I mean, generally, you still have to keep track of your buys and sells because you should track that. But generally speaking, low compliance. You also get the 50% CGT discount if you've held assets or investments for more than 12 months, right? You've got direct control ownership because you're the legal owner of those investments and assets. So if you sell any assets, if you get any income from the crypto, then you have immediate access to it because, well, you legally control it. It's yours. You've been taxed on it, right? So some of the cons with an individual, right? obviously it's subject, people are subject to the highest marginal tax rate of up to 47%. And that includes Medicare levy as well. So all income is taxed to you. You don't have any ability to really move income or divide income. Means it's harder to do tax planning, right? Not as flexible because it's all in your name. Because it's all in your name and you own it, there's also liability exposure, right? If you're ever sued, then they can come after the assets that's in your name. So that would be your crypto assets, right? So a scenario that I would say is pretty common that I've seen. Sarah, she's a hodler. She's a marketing person, earning about 85K full time. She's single. She's got no dependents. She's age 50. Doesn't have anyone else really that she would like to use potentially or give assets to or give income to. She invested about 50K in Bitcoin 18 months ago. And she wants to sell the Bitcoin when Bitcoin's worth about 150K. So the tax impact on that is 150,000 minus 50,000, $100,000 gross discountable capital gain, right? 50% CGT discount brings it to $50,000. Add that to her $85,000 salary, right? And her full taxable income would be $135,000. So the tax payable on that capital gain is roughly about 16% because she's at the 30% tax bracket. So the effective tax she has paid on the gross gain is 16%, right? The net capital gain, or the net gain, essentially net profit after tax, is $84,000. So she's got a simpler situation, lower capital and investments, doesn't have anyone else really that she can utilize. So she keeps it in her name. In this case, simpler is better, right? She doesn't need to go into any other structures. Obviously, this doesn't apply to everyone because there are people out there that are, higher income earners, right? So the next entity we have discretionary or family trust. You might have heard it's used interchangeably, the name. Some of the pros: gives you some asset protection depending on how it's set up because a trust really is run and managed by the trustees. The trustees can be people, individuals, or it can be a company, so a separate, another structure. Right? It's the most flexible vehicle and structure we have in Australia because it allows, what the trust can do is it has the ability to distribute in the most tax effective way to multiple beneficiaries. That can include your family members, trusts, companies, even charities, right? So the trust gives you this ability to stream different income as well. So you say like, oh, I want if the trust has franked dividend, sorry. Let's say, okay, and CGT, oh, I want the franked dividend to go to my mom. I want the CGT to go to my dad, something like that, right? Essentially, it has it's the most flexible vehicle because you can distribute income in any way you want, in whatever quantity you want. Yeah, different types of income can be streamed and distributed, right? And also, when you distribute CGT, it can also distribute it to eligible beneficiaries who are entitled to 50%, right? So you have total control of how income's distributed, again, who it goes to. So it's very powerful for tax minimization. Any like high net wealth individuals with families, in the family group, there will always be a trust somewhere in there to provide that flexibility. Right? There's no other structure that provides the same level of flexibility that a trust does. So some of the cons, unfortunately, you have to distribute every financial year. I can't keep profits in because because of how tax works, if the trust keeps the trust income like capital gains, frank dividends, rental income, etc., the trustees are essentially taxed at 47%, right? So it has to distribute for tax purposes, otherwise it'll be taxed very heavily, right? So you have to distribute by 30 June, essentially sign a trust distribution minute by 30 June, otherwise 47% tax, right? So because a trust has or gives more flexibility, it means there's more options, more scenarios to look at to minimize tax. There is more complexity with it. Trusts are private structures or entities, and they're very, there's a trust deed that you always have to look at to ensure that you're following trust rules and not breaking any trust rules. So it can be complicated. You need to do financial statements and tax returns for it to keep track of the distributions, because beneficiaries are entitled to those distributions. They can ask for whatever distributions the trust has made to them, right? So they need to know as well. So it can be more complex to administer. And the other thing is that you really need family members that you can actually trust to utilize a trust. Otherwise, example in Sarah, in the previous example scenario, she didn't have anyone else really to distribute. Her affairs were simple, right? Would she need a trust? Probably not, right? Doesn't make sense for her. Right, so we got a scenario for trust. We got Brian and Casey, they're smart stackers. Brian, he's an architect, earning 200K in salary. He's owned Tesla shares for a couple of years, right? Casey, she's an artist, earning $10,000 in salary, also has a $50,000 prior year capital loss, right? So they set up a family trust, and they loaned $400,000 into the family trust to buy crypto through independent reserve, and then they stake it. The trust earns about $40,000 in staking rewards for the first year. All right, so what's the strategy here? Obviously, we've set up a trust, right? Brian then transfers his Tesla shares to the trust at market value. That will trigger carry forward capital loss in his name of $40,000. In this example, let's just say he bought his Tesla shares for $200,000 more than 2 years ago. And at the time of transfer, it's worth $160,000. So he's actually down on his investment when he transfers it, right? And because of how CGT works, it's $200,000 minus $160,000 when he bought it. So other way around. $160,000 minus $200,000 when he bought it. So $40,000 capital loss included in his name, right? Staking rewards and trust, it's distributed to Casey because she's taxed less. Makes sense to distribute it to her, right? Sometime later, they sell some crypto, triggering about a $90,000 capital gain. We make a decision by 30 June, sign a distribution minute to distribute $40,000 and $50,000 capital gains to Brian and Casey, respectively. Because if you remember, right, Brian has that carry forward capital loss from when he transferred the Tesla shares. So let's take advantage of that. Casey also has a $50,000 carry forward or prior year capital losses from previous years. So let's take advantage of that. Essentially, the $90,000 gross, $90,000 gross capital gain has been net out with all the capital losses. Right, so we've taken advantage of the situation and distributed it accordingly. So hopefully you can see a trust has the ability to really, that's why it's called a discretionary trust, same as family trust, because you have ultimate discretion to distribute income whatever way you want, however way you want, to whoever you want, right? So it's perfect. A trust can be perfect for families with income disparities. Right, next one, we got a private company. So some of the pros of a private company or company, PTY Ltd, right? It's got limited liability. It's actually it's a separate legal entity, almost like a third person if you want. Just think of it as like a third person. So if the company owns the crypto and assets, then it's separate to you. So that gives you some form of legal asset protection. If you were to ever be sued, well, the crypto assets are in a company. That's again, a separate legal entity. It's also got flat tax rates, so we know at least what the tax is going to be. It's either 25 or 30%. That's versus 47% in your personal name at the highest marginal tax rate, right? The other thing is when a company pays tax, it gets franking credits. Franking credits is just tax credits that that the company can later use when it pays dividends. So when it pays a dividend, it can attach tax credits to it, and you might be able to actually get a tax refund. So you might be able to pay less tax than a 25 or 30% flat tax rate that a company has paid because it was able to pay a dividend to a lower person, something else that had a lower taxable income of 30% or 25%, right? So it got a tax refund in that case. Company can retain profits, unlike a trust, which has to, because of tax reasons, distribute every financial year if there's any trust income. A company can actually keep whatever it makes. So that's a very powerful thing because essentially a company allows you to control timing, right? You don't always want to pay out profits or pay out any gains or anything that you've made to someone because maybe everyone is on highest marginal tax rate of 47%. So it doesn't make sense to pay something. So it's like, okay, we'll just keep the profits of whatever's been made in the company. Right? So just again, to reemphasize, trust allows for, because these two are crucial essentially to any tax optimization, right? Trust allows to control the income of like where it goes to, who it goes to, in what quantities, etc. Right? And then a company allows you to control timing and when. Right? Very important mechanics. But if you have those two control mechanisms, you've got everything set up, and you have the most flexibility that's allowed or that exists in Australia. So some of the cons of a company, it doesn't get a CGT discount, unfortunately. It is taxed at the flat tax rate, 25, 30% on the full capital gains. Not the end of the world because of the franking credits, right? So not always an issue, or not always an issue depending on how structures are working and where the source of funds is coming from. Doesn't necessarily mean it's the worst thing, right? But it is one of the downsides. There's no CGT discount. It is complicated to get money out or get profits out of a company. So we can go into Division 7A territory for tax. If the company's made profit and you're trying to like pull it out somehow, right? Because usually when there's profits in a company, you have to either extract it or pull it out through a dividend, through wages, and they're taxed, right? So, or maybe you can pull it out maybe through loan repayments, which is not taxed. So it can be more complicated to get the profits out. And because a company, right, the structure is it has shareholders, it can only pay dividends to shareholders, really. So it's less flexible compared to a trust where, yeah, absolute discretion. Company can only pay dividends to shareholders. Right, so we've got an example, David, not me. He's a crypto trader. He's a transport engineer earning 200K salary. He's made about 600 crypto transactions in a financial year. So what do? We set up a company so that he can trade crypto through it. He uses about $210,000 of his savings to trade in this new company that he set up. So apparently he's done a great job and he's made 250K trading crypto. Right? Trading crypto, trading is distinct to investing. Hence why he's doing it through a company. Right? Because again, capital gains, there is no CTT discount in the company, so it doesn't matter. So yeah, the company's made 250K doing gains, doing crypto trading. The tax is 25% in this case. So that's $62,500 of tax versus if he did it in his individual name, he's at highest marginal tax rate. So it would have been about $117,500 personally. Right. So by doing it through a company, he's been able to save about $55,000 in tax. Now he keeps a profit and he's able to reinvest those profits back into the company to keep trading or do whatever he wants within the company. Right. So that allows him to compound his profits. Later on, he pays a dividend to himself when he quits work because he went backpacking. So he's on a lower taxable income. So in this case, all right, he doesn't pay out the profits until a later time when he's a lower income. And it's like, oh, okay, you're on lower taxable income. Let's try to take some of those profits out from the company. That way, maybe he gets a tax refund on the 25% tax that the company has already paid. Right. So in some cases, yeah. This is a company can be ideal for active crypto traders that want to keep trading and reinvest profits. Right. Again, we've given him the ability to control when profits can be paid. Again, that's another knob that you can control, right? In terms of when, right? Sometimes, again, like I said, you don't want to pay dividends when, he's earning 200K. Pay it when he's earning lower income. Right, next vehicle structure, we got the self-managed super fund. Now, this is I'd say it's a natural progression for anyone who's used all their personal funds to buy crypto, invest in crypto. They then ask, is there anything else? They look at super and then they're like, oh, wait, I can invest in super through I can invest in crypto through a self-managed super fund. Right? It's a very natural progression in any crypto native journey. So some of the pros of an SMSF, it has the lowest tax rates. So 15% tax is the standard when it's an accumulation phase, like for young people like us before retirement, 15%. It's also if the SMSF has held assets for more than 12 months, tax is actually just 10% for that. The effective tax rate is 10% for long-term CGT assets, right? And then in other scenarios, if you're able to, if the SMSF is in full pension phase, it's 0% tax. So I'll go over that. That's great. You can't get better than 0% tax in Australia or anywhere probably, right? So some of the reasons why an SMSF is always looked at eventually. Self-managed super funds gives you the most freedom and flexibility over your superannuation investment strategy. You can fully control what you invest in, whatever you want to invest in, what quantities you invest in, timing. You can go in and out as many times as you want. Maybe not recommended, but anyway. So you have complete control. And it's actually the only way. I know there's this, you've probably heard the mantra, not your keys, not your coins, right? You have to assess your own security situation to see If that applies to you, not always the case. But an SMSF is the only vehicle that allows your superannuation fund or super to be self-custody. You can only self-custody crypto in super through a self-managed super fund. Right. And it's the only other way that you can directly buy crypto through superannuation. It's through a self-managed super fund. Right. So those are some of the cons of an SMSF. Now, those are some of the pros. So go through some of the cons now. Obviously, superannuation is for retirement, so you can't use this for personal reasons until you've met some sort of condition of release. I mean, there are exceptions, unfortunate life events, but hopefully you don't ever get into that situation. Highly regulated. There's a lot of rules and complexity with superannuation investments. It needs to go through an SMSF audit every year, right? So your accountant will do that and help you throughout that process. There's additional super rules because it's superannuation. There's super legislation specifically carved out for this, right? There's also, high cost, yes. It is generally speaking more expensive than superannuation fund, but I would say it's not orders of magnitude more expensive compared to a super fund like Q Super, Australian Super, Host Plus, right? It's not orders of magnitude, but it's generally more expensive. Anyone that goes and looks into this, when they do the cost benefit analysis, and it's up to everyone to make their own decision, right? When they do the cost benefit analysis, they come away and say, okay, yeah, it's more expensive, but the returns, well, I think that's why a lot of us are here on crypto, right? Unfortunately, there's some DeFi limitations because superannuation has restrictions on borrowing and lending. So DeFi is difficult in an SMSF environment. Right, so we got a scenario. Tim, not this Tim from Independent Reserve, he's a Bitcoin Maxi, right, in this scenario. He's got 400K in his retail super fund. And again, he's a Bitcoin Maxi. He wants Bitcoin ownership in his super. No other super funds, retail, they're not offering him to buy crypto directly or buy Bitcoin directly through super. So what does he do? Sets up an SMSF, rolls over his 400K into the SMSF, buys Bitcoin through Independent Reserve, transfers, buys a hardware wallet first through the SMSF, then transfers the Bitcoin to the hardware wallet. He DCAs into Bitcoin with, his employer super contributions. Like, heck, why not? He doesn't trust superannuation retail funds anymore, right? He's a Bitcoin Maxi. So what does he do? He waits until retirement, starts an account-based pension with $2 million, which is his whole member balance. So the whole SMSF is in pension phase. Essentially, any future income or CGT, tax-free, right? So he's got complete sovereignty over his retirement with crypto. I will just give a caveat because the government just announced made an announcement about Division 296 in superannuation and extra tax. So I will just caveat that out. We don't have anything concrete at the moment. It was just an announcement. We don't have draft laws or anything, but the announcement mentioned $3 million and $10 million. We really have to see what the mechanics of that will look like to better advise. Again, right now, it's just, I guess, speculation. Next, we'll just go over a typical power couple. So it's a case study scenario. We've got Ethan. He's a software engineer earning 220K salary. Mia, she's a designer, 40K salary. They've got 500K in savings, also 300K in super. Right. So what do they want to do? They want to use some of their savings for crypto trading and investing, or actually Ethan. He's a software engineer, so it's probably him, right? Ethan wants to do the crypto trading and investing. Mia's pretty good. She trusts Ethan, right? So they want a comprehensive crypto structure. And this is typical where you'll see structures for every stage or activity, right? It's because he wants to do crypto trading, investing, and retirement. So with the trading part, we've set up a company for him to trade crypto through. So he does high frequency altcoin trading with $100,000. Another good trader made 150K profit, taxed at 25%, right? So if he had done that in his personal name, it would have been much higher at 47%. So the tax savings here is $33,000 compared to his personal rates. Sorry, I know I'm going a little bit over 30 minutes. I'll just try to speed it up a little bit. The other activity, they want to invest 200K. They want to invest 200K in Bitcoin and Ethereum for the long term. So they set up a trust, put 200K, buy Bitcoin and Ethereum through independent reserve. They eventually sell 200K of Bitcoin. That generates 150K gross discountable gain. Okay, Mia, in this case, is on low taxable income. We distribute that to her, right? So it's discounted by 70K, discounted 50%. So $75,000 taxable income is included in her name. At that rate, she pays about $24,000 versus if that investment was in Ethan's name, which would have been $35,000. So the CGT tax savings of about $11,000 there. The trust also owns the shares of the company. So remember, we have the company, and it has shares. The trust is the shareholder of the company. That means the company can pay dividends down whenever it wants to the trust. The trust can stream that dividend to whatever it wants, whoever it wants, in whatever quantity it wants. So the most powerful, flexible vehicle structures that we can do here. Company, trust is the shareholder, right? Finally, we have the SMSF, super. Obviously, they want it in crypto. They set up an SMSF, again, buy Bitcoin and Ethereum through independent reserve. The flat long-term capital gains, if they've held it for more than 12 months, effective tax rate is 10%, or if they are able to get the SMSF in full pension phase, can be 0% tax. So the strategy with optimize for trading profits through the company, any long-term investments we've done it through a trust to allow for distribution. Again, the trust is the shareholder of the company. Retirement savings is an SMSF now because they want to get their super into crypto. They've also got some asset protection because it's in various structures, right? Got company and trust. So we've given the ultimate flexibility for their situation. The combined tax savings is about $44,000 in this scenario, right? All right, so that's the end of it. If you do come through to consensus layer and you set up a structure, mention the code CL+IR, get 10% off any structures that we help you set up. Those are my contact details. Book a consultation through the website if you want to. If you don't already know, you've got Tim's details here. And yeah, let's go through some Q&A.
Thanks, David, for running us through that. I do think that I am the Tim in that Bitcoin Maxi scenario.
Okay.
So we have a question come through. For everyone else, if you do have questions, there is a question section where you can drop them, and we'll run through until we run out of time. But the first is from Lauren. I'm crypto in my personal name and also have an SMSF. Can I transfer the crypto in? Does Tim have to pay personal tax when he transfers the crypto to his SMSF? Confirming he has to buy a new SMSF ledger. So there's kind of a few sub questions under that. I think the gist is what happens when you transfer crypto from your personal name into the SMSF from that perspective. And then there's a bit of a compliance question in that around storing and setting assets.
Okay, cool. Yep, very common question. Okay, cool. Yep. Sorry, just rereading the question as well. So technically, to get crypto from personal or anywhere else into an SMSF, unfortunately, you can't directly transfer crypto into an SMSF. right? So what you have to do is the workaround is, same tax outcome. You have to sell your crypto into cash and transfer cash into the SMSF and then repurchase it through the SMSF, right? Um, Unfortunately, because of superannuation rules, superannuation or SMSFs can really only accept a few assets as contributions, right? So that's the unfortunate thing. A couple of extra steps, but you still can get crypto that you have personally within into an SMSF. It's just a bit of a workaround. They will pay, well, sorry, I'll rephrase. There's a calculation, a tax calculation when you transfer crypto to any other entity, right? So it's at the time of transfer from, let's say, your name, it's market value minus whatever the cost base of that. Generally speaking, it's purchase price, but if you've done some swaps and other crypto DeFi activities, it could be it's likely it will be a different cost base compared to your purchase price, right? So it can be capital gains tax. Sometimes, though, it can be actually a capital loss. So in the example where we transferred from Tesla shares to the trust, right? That was a capital loss in that person's name because he bought it for, let's say, $200,000. And then at the time he transferred the Tesla shares, it was $160,000. So it's 160 minus $240,000. And that's a capital loss that he includes in his individual tax return, right? So sometimes it's positive, sometimes it's negative. Obviously, it's good to do this from the start so you don't have to do that, right? And to get it, a clean start's always better than restructuring, right? Sometimes it's also beneficial because in a bear market, that's probably actually, the saying, I think, in crypto, Tim, as well, build in a bear market, prepare in a bear market, right? So some people have had losses or it's flat in bear markets. That can be a really great time as well to actually restructure. In terms of the SMSF, it should buy a wallet. Like it should be the one that buys the ledger and hardware wallet, and then it can actually self-custody crypto, as I mentioned before. It's the only vehicle, or the only way in superannuation that you can actually self-custody crypto. So why a lot of people choose to go with an SMSF rather than have it in their own retail industry, QSuper, Host Plus, etc. Cool. All right. I'll get through a couple of. Actually,
Is the summary of that if you're transferring from a personal account to an SMSF, that you need to crystallize the gain or loss in your personal as an individual, and then you cost base for your SMSF?
Yes, that's right. Sorry, that's the other thing I'll mention. There is a new cost base, whatever. Yeah. Essentially, the sale in your personal then becomes the cost base in the new entity. Right. All right, I'll just go through another one. Aaron, I have SMSF and don't plan on training any crypto until it's in retirement phase. Is it CGT free the whole way through? Yeah, so in Australia, if you really just buy and hold, and that's all that happens with your crypto activity, there is no CGT or tax that happens. So I hope I assume like you want it to be tax free. So what you can do, is wait until you hit retirement phase in your SMSF, and then sell or trade, and then it will be CGT free. So the strategy usually is accumulate. When you're close to retirement age, accumulate as much as you can, hold off on selling and doing much income activities through the SMSF. Hit retirement, start an account-based pension so that it's in retirement phase. Hopefully the whole SMSF is in retirement phase. If there's a second member, then maybe you can wait for the second member to hit retirement phase, so that again the SMSF is in full retirement phase, and then afterwards, okay, you're all good, 0% tax, hopefully. Except again, the caveat is the announcement from the government about the $3 million for each individual and the $10 million. So again, we'll see. Yeah, we'll have to see. But an SMSF is still the lowest tax environment in Australia, and like the strategy is that you can make it 0% tax for now.
All right, there's a few questions, Rob. So we might need to give
I'll speed it up. Yeah.
Answers, and if customers want to connect with you after, then they've got your details to do that.
Yeah. I'll just go through and read them. Actually, it'd probably be faster. I've also put my KYC account on behalf of myself and a friend 50-50 basis who is financially okay. Have set up a bare trust to stay there. Oh, okay. I'm going to read. Okay. My question is whether the setup of a bare trust deed starting and listing. Is ATO look, I think that's okay. We do get some of these questions where you've bought something on behalf of someone else. That's a very tricky question. That's probably a more legal question. I would refer you to a lawyer for that. Yeah, rather than answer that. I'll just move on to the next one. Yeah, answer that one. If you stake Solana for a few years and compound it, are you forced to pay tax on unrealized staking? Am I forced to sell some staking return to pay tax from my unrealized Solana? Okay. Right, okay, so when you say unrealized, this can be, I would say it's dependent, but I think the ATO's view is whenever you get staking income, you can obviously get it out and sell it straight away if you wanted to, right? It's not locked. Locked may be a different situation, but where it's not locked and you can take it out, the staking rewards, and sell it straight away, the tax event is that you have to declare that as income and it gets taxed, right? So unfortunately it might be different if it's in a locked situation. Next question. I've bought crypto. Oh, this is sorry. Oh, okay, yeah. That's all right. If in the future Bitcoin could be used to purchase everyday items like race cars, etc., would that remove the CGT implications? Look, that's definitely a more legal tax question. I mean, I don't have the answer to that. Yeah, money is a very special property. I mean, you could kind of already use it for everyday purchases if you wanted to. So I'm guessing what you mean is like legally if it's money to be used to purchase every day. But right now it's considered CGT asset. Again, I don't know. If it's considered money, it potentially is not taxable because it's not a CGT asset anymore. But again, that's a future speculative comment.
So as of today, if you went out and bought a loaf of bread with Bitcoin, would you be charged capital gains tax on what you've sold in that event?
Yes, you would if you were holding it for personal reasons. Sorry, for investment reasons. You held it for long-term capital appreciation and you decided to buy $5 worth of bread with your Bitcoin. Unfortunately, there is a CGT calculation on that. Like $5 worth of Bitcoin minus whatever the value cost base of that Bitcoin was. Yeah. Let's see if there's any other questions.
I think that covers it for now.
Yes. Yeah.
Individual Reserve obviously does support all of those four account types: individual, company, trusts, and SMSF. So we don't do the structure. You would go to a consensus layer or your accountant to get that set up. Once you've got the structure, we can help you set up the crypto account, help you work out the bank transfers and and get you into crypto. So you have our contact details if you want to reach out. And other than that, thank you for joining, and hope you learned something new. And we'll be running a series of these. So hopefully you can join the next one as well. Right.
I think the handouts will there'll also be a recording. Forgot if you mentioned that already. The recording will be sent out afterwards as well.
Great.
Cool. All right. Thanks everyone for joining and asking questions. Hopefully you learned some stuff.
Great. Take care.
All right. It was good.